Welcome back to the channel, everybody. This week we're going to be talking about Bitcoin and how it is changing money forever and how it's being digitized. So I know we've covered a similar topic before, but this will be a bit more in depth, and we'll talk a little bit more about central banks and some issues with them that Bitcoin serves to resolve. And we'll also touch on decentralized finance a little bit. So I hope you guys can learn something new, and I'll see you all next week. Hi everyone, welcome back. This week we're talking about Bitcoin and how it's changing money. So Bitcoin is a huge topic right now, and cryptocurrency in general is kind of what's topping the news lines and everything. So today we'll outline some critical components in its success and why it will and is changing money forever. So we'll start by discussing the primary issues surrounding central banks and illustrate how Bitcoin enters the picture. And we'll also talk about some pros and cons, and finally we'll wrap it up with a discussion on decentralized finance, or DeFi for short. To date, the majority of large market crashes, including the Great Recession of 2008 and the Great Depression of 1929, were initiated by the mismanagement of central banking authorities. This has created a desire for decentralization of currency and other aspects of the economy, which planted the seed for Bitcoin early 2000s. So now we'll start by talking about Bitcoin first here. The idea behind Bitcoin is simple, yet its structure as a cryptocurrency is pretty complex. So to start, it's a peer-to-peer network, which is done in order to send digital currency from one place to another. Transactions are quick and seamless, and they're very secure, and secure enough through the use of a blockchain in order to forego a financial intermediary such as a bank. Very important in this discussion is some central banking issues that have created the need for decentralized finance and cryptocurrency. Bitcoin initially served to alleviate three central banking issues, and we'll cover those here. The first is the ability to double spend fiat currency in terms of the same coin and dollar being used twice or more times. Cryptography allows a specific public ledger that disallows double spending, and the whole network can actually observe these transactions and verify them. The second is that it eliminates the need for a production/distribution system that central banks utilize. Miners use nodes to mine new coins, which is how it is produced and distributed worldwide via the internet. And this is quite obvious why this is a lot more efficient in distributing and producing coins. And the last one is the idea of trust of the system, which is becoming harder for central banks to establish, but it is seamlessly created through Bitcoin's transparent and public digital ledger. Verification and approval occurs through nodes on the blockchain that immediately reject transactions if they have any disagreement whatsoever, so that only verified transactions appear on the blockchain. Now we can briefly discuss some negative aspects of Bitcoin, and this is an important part as well. So Bitcoin, through its anonymity, is more susceptible to criminal behavior that is not traceable to any one individual. And anonymity is actually one of the most important features that allows Bitcoin to operate. A roadblock more recently has included the pushback from countries and their governments to adopt Bitcoin as legal tender. For example, El Salvador is planning to build a Bitcoin city in which Bitcoin is the main currency and is used for day-to-day transactions all over the city, and normal currency is not accepted any longer. Bitcoin's volatility and limited supply also drastically slows down velocity at which the coins will circulate, and in economics this is called the velocity of money. Volatility of its price also limits its use as a point of sale currency, since the swings are large at times, changing the value of the coin from random changes. This makes knowing the value of coins you carry very difficult for consumers, and you'll need to often be checking an app or some other charting software that tells you the immediate price in order to make a purchase. Since the onset of the cryptocurrency age, since about 2010, central banks have also been working to design their own digital currencies in order to battle this decentralization that's taking place. These are commonly referred to as CBDCs, or central bank digital currencies. This too will function through cryptography and a blockchain system, and will likely eliminate the need for both retail banks and coin-based currencies in general. CBDCs seem the most logical way of the future and a way forward, since it allows some central bank control, but also expedites transaction times and allows a level of decentralization that current central banks don't offer. Venezuela has fully introduced its CBDC system in 2021 that utilizes text messaging to exchange funds on a blockchain. And obviously this would be very quick and efficient, and you don't have to go into a retail branch to exchange money. So now we'll take a quick look at decentralized finance, or DeFi for short. DeFi has become a very large market through the popularity of crypto, and is essentially introducing cryptography and the blockchain elements to the money, derivative, and insurance markets. It mainly aids in the elimination of intermediaries, such as central clearing counterparties, which were introduced after the 2008 financial crisis, in order to streamline ordinary traditional finance. Currently, it's more of a supplement to the financial industry, but it can become larger over time, as it's only about 2% currently. Apps on the Web 3.0 interface offer DeFi services that expedite financial transactions, and again, this is growing as well, so we're going to see more and more of these over time. Now, popular stablecoins such as Tether, which we'll be talking about in the next video, are vital for DeFi since they offer a level of stability to crypto that it does through pegging its value to the US dollar. The traditional banking system relies on private networks and financial intermediaries to ensure the value of money is maintained. And this is very important for the integrity of the value of money. Bitcoin does this through its blockchain, which by design ensures the value remains intact and fairly similar at all times, except for supply and demand changes. This is done by ensuring that there is no coin that's double counted or double spent. And again, this is done through that public ledger on the blockchain. Miners then verify each transaction on the node to verify them and ensure that nothing is being double counted and that there's no fraudulent activity happening. The ability of a blockchain to transform money in this manner is revolutionary and often compared to the internet age of the early 2000s. NFTs, which we'll talk about in a future video as well, also rely on the blockchain to keep the value of artwork, music, and other valuable items. Bitcoin's purpose is to remove monopoly power over value transactions in the economy and to level the playing field for everybody using it. Blockchain has further opened the doors to decentralizing any aspect of the economy that has the ability to be digitized and for assets that hold value. This includes things like news outlets, social networks, money in general, artwork, movies, memes, GIFs, and other things. It also allows complete control by the people as a whole, and as is popularly quoted, Satoshi Nakamoto is all of us, not one person. And this just refers to the decentralized aspect. So we're currently living through the value revolution, as it's called, which as it sounds is serving to revolutionize anything of value into the digital age. So we'll see you all next week.